This is Nightly Business Report with Bill Griffith and Sue Herrera.
Return to normal. The Dow has rallied more than 1,000 points in a week, leading investors to wonder whether the market is starting to stabilize.
Historic summit. A date is set, but North Korea is still evading sanctions, and the United Nations is looking to traders and insurers to prevent that from happening.
Timing is everything. The best day and time to list your house for a fast sale at a higher price. Those stories and more tonight on Nightly Business Report for Thursday, May 10th.
And we do bid you good evening, everybody. At today's closing bell, the Dow found itself back in positive territory for the year after recording a sixth consecutive gain, its longest win streak since February. Why is this happening? Well, inflation fears are abating. Volatility is fading. Today, at least, bond yields fell back. Small caps are near all-time highs, and technology stocks, of course, a market leader, they appear to be back on solid footing as well. So today, it all resulted in market gains across the board. The Dow Industrial Average gained 196 points to 24,739. The Nasdaq was up by 65, and the S&P added 25. Mike Santoli takes a look now at whether the market is just returning to normal.
Investors thrown off balance by swirling markets this year now face a new wrinkle, a sudden outbreak of normalcy. This year, stocks went from an unprecedented uphill sprint in January to a nasty stumble in February, followed by months of confused struggle. But in the past couple of weeks, stocks have stabilized and recovered to a 7-week high as a rush of strong earnings provided support, and stock investors have made a tentative peace with somewhat higher interest rates. This return to a sort of normalcy can be seen from a few different angles. The widely tracked S&P 500 Volatility Index closed Wednesday at its lowest level since January, indicating stocks and stock traders are no longer particularly agitated or fearful. The market has also grown less sensitive to potentially unnerving headlines. When President Trump exited the Iran nuclear agreement and oil prices crossed above $70 a barrel, for instance, the major indexes paused briefly, but then resumed their gentle climb. And stocks and sectors are again moving independently, based on their own news and corporate results, rather than swinging around emotionally in unison. That's typically a sign of a calmer, more rational investing backdrop. The sectors driving the recent market bounce are also somewhat encouraging. Technology, financials, industrials, and energy stocks have lately been leaders, which suggests the market is comfortable with the underpinnings of the economy. None of this is to say the market has worked through all its issues and is destined for a quick return to or beyond the old highs. This remains a fairly prolonged setback, and the S&P 500 remains more than 5% from its January peak. And even in a more normal market, you can still very well encounter the common summer storminess ahead of the midterm elections. Still, the steadier action and more logical interaction among various market segments indicates that investors no longer feel overexposed to stocks, and the economic fundamentals can support them at current valuations, at least for now. For Nightly Business Report, I'm Mike Santoli.
As we mentioned, inflation fears diminished today after the release of a key economic report. The Consumer Price Index rose 0.2% in April. That was less than expected, and it follows last week's employment report that showed wage growth remains stagnant. The report showed that rising costs for gasoline were offset by a moderation in healthcare prices.
Meanwhile, the rate of layoffs in the U.S. is holding steady near a 49-year low. The number of people who applied for unemployment benefits last week was flat from the prior week, but the average of new claims over the past month has fallen by more than 5,000 to touch the lowest level we have seen since 1969. Economists say this latest report supports the idea that the labor market is tight and companies may be reluctant to fire workers.
And as we have reported, an unusually large number of positions are going unfilled, an amount that almost matches the number of unemployed workers. So what does that mean for the job market and the economy, and which companies stand to benefit the most? Joining us to discuss that are Mark Zandi, chief economist at Moody's Analytics, and Mark Hamrick. He's the senior economic analyst with Bankrate.com. Welcome, guys. Nice to have you here. Mark, I'm going to start with you. How unusual?
Which Mark? There's two Marks.
I know, that's true. Mark Zandi, I was going to say.
You go.
How unusual is this phenomena where it's almost a one-to-one, and is it sustainable?
It is
very unusual. I don't think it's ever happened in history. I mean, we've got data back into the early 2000s, and we've never seen anything like it. And it's consistent with all the other labor market data. 3.9% unemployment, a very low underemployment rate. Quit rates are high. You know, people are quitting their jobs, and they don't do that unless they think they can find another one pretty quickly. So this is, you know, very, very unusual, something we haven't seen historically.
Mark Hamrick, then, who's benefiting? I mean, obviously employees, theoretically, they should have some pricing power here, even though we're not seeing wages go up. But are there sectors that are benefiting from this very tight labor market now?
Well, in this latest data set, I think we saw professional and business services, construction and transportation sort of leading the way. But the other part, of course, is that we really do have in some ways a divided America between the healthy larger cities and rural America, which is suffering. So if by some accident of birth or having moved, you're in one of those locations, or you're willing to move, and obviously in one of those healthier sectors, you're going to do better. And you know, there are many parts of the country where workers are not benefiting from this real ascension in the job market that we've been seeing. And it's really almost incumbent upon those individuals to attain skills and to move where the jobs are available.
You know, Mr. Zandi, I'll turn back to you if I can. To pick up on what Bill was mentioning, you would think in a labor market this tight, there would be some pricing power, but wages, although they're starting to move up a little bit, really have lagged behind. Why is that?
Well, first of all, wage growth is accelerating. I mean, if you look at the best wage data, you go back 3 years ago, wage growth was 1.5%, 2% each year. Now it's closing in on 3%. So it is picking up, and I feel very confident it's going to accelerate quite substantively. We collect data based on payroll records from ADP, and based on that data, we can see wage growth across lots of different demographics. And the one fascinating thing that's happened very recently is that wage gains for new entrants into the workforce is surging. So that's a good leading indicator. So I'm confident that wage growth will pick up going forward, and the benefit of this strong labor market will become more evident to more people across the country.
Mark Zandi, where is this going? How long can we have this kind of a tight labor market when you do have these companies, especially I guess in manufacturing and construction, that are scrambling to find workers right now?
Yeah, this is not sustainable. So the one thing I worry about, and I think markets will eventually worry about this, you know, next month, the month after, is that the economy will overheat. That is, you get to a place where businesses just can't find workers, and we're getting to that place. You know, construction, transportation, parts of manufacturing, financial services, professional services. You start to see wages rising. We will see inflation pick up and higher interest rates, and ultimately, you know, it's a problem. So it would be much better, I think, for everybody, including workers, if we saw some moderation in growth and unemployment's kind of hung around where it is right now. If it goes lower, we're going to have a problem. This is just not sustainable.
Mr. Hamrick, does that go to the tight labor market, or does it go to the skills gap that everybody is talking about, or maybe a combination of both?
Well, yeah, and I do think also we need to remember, as Mark sort of ran down the list of positive metrics in this job market and the economy, there are some things that are quite remarkable at this point in time which are not seen as positive. For example, the low labor force participation rate, and the sort of unanswerable question at this moment is, who can be brought back into the job market? How many of those people actually are capable of being trained? They even have the minimum soft skills to enter the job market. And the other part is that I know Mark is along the lines of thinking, and I totally agree, that we could see this unemployment rate get down into the mid 3% range. We've been consistently lowering that as this job market has gotten tighter, and yet we continue to see, you know, on the order of nearly 200,000 jobs being added a month. So a lot of this is a work in progress.
Mark Hamrick, so okay, construction and manufacturing are suffering. They can't find those workers. What about the areas where they are benefiting from this tight labor market? Like what, technology? I mean, are there companies out there you can think of that are flourishing because of this right now?
Well, obviously, it's some of the same FANG stocks that we have talked about, for example, in the publicly traded sector, the Facebooks, the Amazons, the Googles, the Netflixes, some that aren't quite as public-facing. But, you know, those technology giants just continue to gain traction in the marketplace, and that's why they've been a favorite among investors for quite some time.
All right, gentlemen, we will leave it there. Mark Zandi with Moody's Analytics and Mark Hamrick with Bankrate.com. Thank you both. Bill?
Thank you.
The Treasury Department said today it levied sanctions against several Iranian firms and individuals. Treasury officials said that the sanctions target an illegal currency exchange network in the United Arab Emirates. It also accused the Iranian central bank of being complicit in those operations. The action is the first since the U.S. pulled out of the Iranian nuclear deal earlier this week.
President Trump will meet with North Korean leader Kim Jong-un on June 12th. The president tweeted that that summit will take place in Singapore. The U.S. will use that summit to try and persuade Pyongyang to give up its nuclear weapons. This will be the first ever meeting between a sitting U.S. president and the leader of North Korea.
And even as North Korea and the U.S. plan out this high-level summit, CNBC has learned that North Korea is still evading sanctions with covert actions. Michelle Caruso-Cabrera spoke exclusively with the chief United Nations sanctions investigator. He detailed how the North Koreans are violating UN sanctions to illegally import vital oil, and he wants international insurance and trading companies to help put a stop to it.
This highly secure and nondescript office in New York is the headquarters of the UN panel of experts, led by Hugh Griffiths. Griffiths and his team of investigators monitor compliance with UN sanctions imposed on North Korea. Sanctions meant to convince North Korean leader Kim Jong-un to abandon his nuclear weapons program. Recently, as North Korea has agreed to talks with the United States, it has stopped nuclear tests and ballistic missile launches, the most obvious sanctioned activities. But Griffiths says don't be fooled. North Korea is still trying to outsmart the UN.
So while those are clearly not occurring, we have other sanctions violations that are ongoing.
Such as?
Such as ship-to-ship transfers of petroleum products.
That's when North Korean ships buy desperately needed but prohibited oil from other ships at sea, like this ship-to-ship transfer caught by aerial surveillance photos.
One vessel, the Koti, which was transferring petroleum product to this North Korean tanker.
A key trick the ships use to avoid detection? Shutting off their AIS signal. That's short for Automated Identification System. It's a maritime version of GPS intended for search and rescue purposes.
So you know down to the second when that vessel was transmitting and when they went dark.
The ship's signal was off for a week when it was very close to North Korea.
Exactly. In every case of illicit North Korean petroleum diversion that we've seen, the vessels switch off their AIS just before they meet at sea, meaning that they cannot be tracked any longer. So that's an immediate risk indicator.
What is a legitimate reason, if ever, to turn off the AIS?
The only really legitimate reason for turning off the AIS signal is if you're traveling through pirate-infested regions such as the Gulf of Aden or off the coast of Somalia, and you don't want to give away your position to the pirates. I don't see any other legitimate reason.
And this is where the insurance and trading companies come in.
So we just have to get these guys and them on board.
The investigators can't force the ships directly to turn on AIS, so instead they're trying to hit them through their wallets via the insurers and trading companies based in countries that they know will comply. So they've asked these industries to insert clauses in their contracts that demand the ship's AIS signal stay on at all times, or else the ship's insurance will become null and void. For Nightly Business Report, Michelle Caruso-Cabrera.
And you can read more about enforcing North Korean sanctions on our website at nbr.com.
It is time to take a look at some of today's upgrades and downgrades. Macy's rating was cut to underweight from equal weight at Morgan Stanley. The analyst cites the company's sluggish sales and says it needs to do more to get rid of underperforming stores. The price is $25. Shares fell more than 2% to $29.42. AIG's rating was upgraded to buy from neutral at Goldman Sachs. The analyst there cites the company's strategy and effective execution. The price target is $64. The stock fell fractionally to $52.75.
Anheuser-Busch was given an outperform rating in new coverage at Macquarie Research. The analyst there cites the potential for organic sales and profit growth. Price target $113, but the stock did fall today by 2.5%. to $95.40. And Tinder owner Match Group saw its rating raised to buy from neutral at UBS. The analyst does not think that Facebook's entry into the online dating business will have a material impact on Match's future growth potential. UBS also said the stock's recent sell-off presented a good value opportunity. They have a $48 price target right now. Shares rose more than 5% today to $38.91.
Still ahead, the road ahead. What Ford's chairman said just hours after halting production of its most profitable vehicle. Apple's shares closed at an all-time high, rising for 9 straight sessions as the company's market value closes in on $1 trillion. The stock has been fueled by Apple's $100 billion buyback plan that was unveiled last week. Today, the stock rose more than 1% to $190.04. It has to close at $203.45 to hit that $1 trillion mark. Its market cap is currently $934 billion, followed by Amazon at $780 billion and Alphabet at $765 billion.
We're getting closer. Meanwhile, Apple and Goldman Sachs are reportedly teaming up to launch a new joint credit card. The Wall Street Journal says the agreement would expand Apple Services business, broadening Apple Pay's reach. Deal also marks Goldman's first move into credit cards as it pushes further into consumer banking.
Wells Fargo improperly collected fee rebates that should have been given to a public pension fund. The bank said it was the result of a system error and that it returned $15,000 to a Tennessee Fire and Police Fund. This follows a number of setbacks for the bank, including its fake account scandal that surfaced in 2016. Shares rose today on a separate report that the bank's earnings won't get hit as hard by regulatory caps as originally thought.
Lawmakers today released thousands of Facebook ads created by Russian entities before and after the 2016 presidential election. As Julia Borston reports now, the ads point to the size and scope of Russian manipulation on that platform.
House Intelligence Committee Democrats have published some 3,500 plus ads, events, and pieces of content that the Russian Internet Research Agency ran on Facebook and Instagram between 2015 and 2017 in an effort to manipulate the 2016 elections. Some of the events are legitimate events, such as rallies and protests that were organized by Americans but promoted by the Russians.
This is the problem with an open platform with 2.1 billion people on the system and 6 million advertisers. It's really hard to police, and again, I think that this just shows you the complexity of what they've created.
The ads, which were seen by over 33 million Facebook users, target a range of divisive issues, ranging from anti-Hillary Clinton messages to debate around immigration to anti-gun control ads. Facebook says that they gave these ads to Congress so that they could better understand the extent of Russian interference in the last U.S. presidential election, explaining that in the run-up to the election, Facebook was more focused on more typical cybersecurity attacks and that they were slow to spot this type of information interference. Facebook saying, quote, "Since then, we've made important changes to prevent bad actors from using misinformation to undermine the democratic process."
It's going to take more money and time to fix this, and we think that they've laid out a pretty aggressive strategy to put the company ahead of shareholders and ahead of profits. Our belief it won't be a material impact, given that some of the technology can actually do this at a very low cost.
Facebook outlining 10 big changes that the company has made to prevent this kind of manipulation from ever happening again, including ads transparency, verification and labeling of any ads around issues or political candidates, and better technology to disable fake accounts and crack down on fake news. Facebook says it understands that the company needs to take a broader view of its responsibilities and that this will be a battle that it will always be fighting. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Eli Lilly makes a push into immunotherapy, and that's where we begin tonight's market focus. Eli Lilly is buying immunotherapy-focused biotech Armo Sciences for more than $1.5 billion. The merger signals Eli Lilly's desire to invest in the therapy that uses a patient's immune system to fight cancer cells. Shares of Eli Lilly rose 2% to $80.86. Meanwhile, shares of Armo Biosciences skyrocketed 67% to $49.80. Higher distribution revenues helped AMC Network grow overall earnings and sales at a faster than expected clip. The owner of networks AMC, BBC, and Sundance said viewership remains strong for many of its shows. Shares popped 8% to $57.51. And the French insurance giant AXA sold its U.S. business in an initial public offering. Shares of AXA Equitable Holdings debuted on the New York Stock Exchange at $20 a share. That was below the initial range of $24 to $27. While the company didn't raise as much as had been expected, the CEO told Sarah Eisen that he believes the value of the business will be reflected in the stock price in the long term.
I think markets go up and down and pricing is set by markets. We can't control that. Really, what we know we have to do is run our business well, develop good solutions for clients and give good service. And over the long term, I think the markets will recognize that.
These shares finished up nearly 2% to $20.34.
After the bell, chipmaker NVIDIA reported a stronger than expected rise in profits and revenue as demand continued to grow for its graphics chips. The company also gave revenue guidance for the current quarter that was above estimates. Shares were initially volatile. After hours, they ended the regular session up more than 1.5% at $260.13. And software company Symantec reported improved earnings after the bell, but the results still came up shy of estimates. The company also warned that an ongoing internal investigation may delay the release of its annual results and financial guidance. And shares, as you might imagine, fell in the extended session. They ended the regular session up 1.5% at $29.18.
Shares of Ford moved slightly higher today after the company's chairman told investors that he wants to kickstart the stock. The automaker's annual meeting happened just hours after the company shut down production of its most popular model, the F-150 pickup. Phil LeBeau has more on the trying times facing Ford.
With production of Ford's F-150 now stopped, the question for customers and investors is how long it will take to get assembly lines running once again. Ford is working with the supplier, whose plant in central Michigan was knocked out by an explosion and fire last week. For now, Ford has plenty of trucks in stock, but the pickup business is highly competitive. Ford may be the leader, but GM is nipping at its heels, and Ram has been steadily picking up market share. While Ford says second quarter results will be impacted by the shutdown, it's reaffirming full-year earnings guidance. The bigger question for investors is what it will take to get the stock moving higher. Bill Ford, chairman of the automaker, understands the frustration.
This business can get fitter, and it will get fitter, and we have more actions to come that will show that.
CEO Jim Hackett's turnaround plan calls for developing autonomous vehicles and mobility services that will create new revenue streams for the automaker.
We'll drive new, what we call sticky revenue, revenue that stays during good times and bad times, and that creates profit streams for us. We see ourselves not just as a provider of mobile solutions, but also as an orchestrator of digital connections from vehicle to street to business to home.
But until Ford develops those future revenue streams, it will lean heavily on its truck business. And right now, that business is under pressure with production of the F-Series being stopped. Phil LeBeau, Nightly Business Report, Chicago.
Coming up, the best day to list your house to sell it faster and for more money.
Huge demand and lean supply makes this spring a seller's market in housing. But that doesn't mean every house will sell quickly or for top dollar. As Diana Olick reports, there are some strategies every seller should know.
Even in a housing market with next to nothing for sale, timing is everything. Listing your home on a certain day and even a certain time of day may make it sell faster and for more money.
Thursdays. Our market is programmed to look at houses Thursday.
Yes, most agents agree if you list your house on Thursday, it will sell faster. And real estate brokerage Redfin ran the numbers on each day of the week, also finding Thursday is best. Why?
You really want to have the most eyes on your property and Thursday seems to be the day to do that.
Most buyers today shop online first and then decide which homes to visit, and most do that just before the weekend, planning on Sunday open houses. Some agents, though, think Friday gets you more buzz and urgency at the open house.
Tons of people all excited, whispering to each other so that, they don't tell the other people that they're really interested in it.
Timing the debut for your listing is vital because a listing will get 5 times more views on its first day than on the next few. That's because most listing sites offer alerts to potential buyers when something new comes on. But even the timing of that alert can make a difference.
The afternoon is better because on Thursdays, all of us are listing. And so if you list in the morning, you end up actually on page 2.
Myers likes to put her listings online at 5 p.m., just when people get off work and head home to search for a new home. For Nightly Business Report, I'm Diana Olick in Washington.
Now you know. You can find more home selling strategies on our website at nbr.com.
Finally tonight, the ongoing Rockefeller auction at Christie's so far has raised more than $760 million, and it's not over yet. Last night marked the close of the art portion of the sale, which saw 14 records and included the highest total ever for a sale of American art. Tonight's sales are devoted more to furniture and porcelain, and as we've been reporting, all proceeds from this historic auction of the Rockefeller estate will be going to charity.
And before we go, here's another look at the day on Wall Street. The Dow advanced 196 points to 24,739. The Nasdaq is up 65, and the S&P 500 added 25. And that does it for us tonight. I'm Sue Herrera. Thanks for joining us.
Indeed, I'm Bill Griffith. Thanks so much for joining us. Have a great evening. We'll see you tomorrow.